Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
This is ETF Market Insights. Welcome back. I'm Danielle Neziol with BMO ETFs. And today's show is all about tax loss harvesting, or tax loss selling, as it's often known. As we get into the year end, a lot of investors are looking at their portfolios from a tax perspective, trying to figure out how they can optimize tax strategies. So we have John Waters here today, who's basically our BMO ETFs in-house tax consultant, but also he's the head of tax consulting at BMO Private Wealth. John, it's so great to have you on the show with us today.
It's my pleasure, Danielle.
John is very insightful when it comes to all things tax related, and we're so happy to have his expertise on the show. But before we get started, we do want to remind you, John and I, we're not giving you any recommendations today. We're not providing any advice. Today is all about empowering do-it-yourself investors to give you the tools and education you need to properly manage your own portfolios. We are going to be talking a bit about tax today. John is a really great tax expert, but at the end of the day, we do not know your own specific situations at home. So always consult your own tax consultant when looking at things like this down the road. So John, today we're talking about tax loss harvesting, which is a tax loss strategy that investment advisors use all the time. So it's really exciting to tell do-it-yourself investors how they can also execute this strategy. So John, basically, let's open up. What is tax loss harvesting and what are its main benefits for investors?
Yeah, sure, Danielle. I guess we're at that time of the year when we start to think about the strategy, perhaps even in October. But really what it's doing is it's a year-end tax strategy where you're reviewing your investment portfolio year to date, and you're tallying up all the capital gains that you've realized in your non-registered and taxable accounts, and looking at all the capital losses that you've realized year to date on securities, doing sort of a netting of the two and figuring out, are you in a net capital gains position or a net loss position? And to the extent that overall you have net capital gains, if you did nothing, otherwise you'd be paying tax when you file your tax return in April. So one possible tax strategy is to consider realizing some capital losses on some securities that you hold, again, in your taxable non-registered accounts, to reduce that capital gain that you'd otherwise pay tax on. And to the extent that you're in a net loss position, you could potentially carry back that loss to prior years, the 3 prior years, so 2020, 2021, and 2022. If you pay tax on capital gains in those years, you could generate losses or increase your losses to get a refund of those taxes in the prior years. So that the benefit of this strategy is to either reduce your tax bill in the current year or potentially recover some tax that was paid on net capital gains in the 3 prior years.
Reducing a tax bill, that's something a lot of investors definitely keep their eye on. You know, we always talk about managing our investment portfolios from a performance perspective, but tax certainly is impactful with that bottom line. And just to highlight, today we are talking about taxable accounts. So if these losses are in something like a TFSA account, the strategy won't apply because those are tax-free accounts. Just wanted to make that clear. So John, how can an investor at home successfully execute a tax loss strategy? What are kind of the steps that investor needs to take?
Yeah, well, as I mentioned, I think the first step would be to sort of take stock of where you are at for the current year. So you're looking at your investment portfolio, again, focusing on your non-registered accounts. It's important to realize too that we're looking at the aggregate of all of your taxable non-registered accounts. So if you have them at different brokerages, you want to look at all of them, and you're calculating your net capital gains or net capital losses year to date. And as mentioned, to the extent that you've got an overall capital gain, you then might wish to look at some securities that are currently in a loss position and considering the sale of those securities before the end of the year to trigger that loss to offset against your capital gains to reduce ultimately that tax bill when you file. Now, keep in mind that you're going to want to take stock of your investment mandate, and you're doing this for investment purposes. Don't let the tax tail wag the investment dog, as we like to say, but make sure that it makes sense from an investment perspective. And to that end, another consideration with tax loss selling is that there is a tax rule that deals with something called a superficial loss. So this is a scenario if you've sold a security at a loss that you can't repurchase that within the next 30 days and continue to hold that security at the end of that 30-day period. So you have to sit on the sidelines for a while on that specific security. So you can't get right back into it. So another reason why it's important from an investment mandate to make sure that you're selling the stock for investment purposes. I guess the other point that I would make is it might be possible to find another security that sort of mirrors or has a high correlation with the one you're selling, because you can't go back to that specific security within that 30-day period, or the loss will be denied under the superficial loss rules.
Okay, that brings us to a great segue into my next question is, why do ETFs make sense to help facilitate the strategy? Because like you said, John, if your investment thesis as an investor is still very high conviction in that specific stock or that specific sector area of the market you're holding, but you're on a loss, making that sale and having to be on the sidelines for 30 days could interrupt that investment thesis. So looking at ETFs might make sense in helping execute this strategy more successfully.
Absolutely, Danielle. I think the point is valid. Is a lot of times you might like the long-term prospects on a particular security, but it may be down for right now, and it may be a good candidate for the tax loss selling strategy. But as mentioned, you'd have to sit on the sidelines, can't get right back into that same security, and you'd have to wait at least 30 days. So there's some fear that you might miss out on the upside if you do like the longer-term prospects. So what ETFs can do is give you an opportunity to get back in and share on that upside that you think may be coming. So oftentimes you'll have a specific security, maybe it's a bank stock, and you sell that, trigger your loss for the strategy. You might want to get back into an ETF that offers a tracking of the bank index in the hopes that may recover in that 30-day period. So something that would have a high correlation or similar exposure as the security that you sold, so you don't miss out on that activity over the next 30 days. So ETFs obviously can give you that targeted exposure. There's many to choose from. Give you diversification. Instead of that single stock risk, low cost, and of course many other benefits of ETFs as well.
Yes, ETFs definitely, one of the many benefits of ETFs, they definitely help out those who are trying to execute a tax loss strategy. Banks was a great example. So we look at a lot of sector ETFs as helping investors facilitate maintaining that exposure if they'd like to crystallize a loss. Great example, especially for 2023, we're seeing a lot of the big six Canadian banks are down for the year. So if this is something, if you bought a single stock, big six Canadian bank at the beginning of the year, you might be sitting on a bit of a loss. You have that ability to crystallize that loss before the end of 2023 and maintain that Canadian bank exposure and move into an ETF such as a ZEB, the BMO Canadian Banks ETF. Another sector that's sitting on a few losses so far year to date are REITs. So if you're an investor that's holding a REIT security, Again, you can look at that. If that's down this year, there are ETFs out there such as ZRE that maintain that exposure to the Canadian REIT sector. I should also highlight too, when we talk about year-to-date returns, I know this is often in tax loss strategies, when we're talking about year-to-date returns on single stocks and comparing them to ETFs, but that doesn't always mean you would have bought that security this year or at the beginning of this year. So when you are executing a tax loss harvesting strategy, you have to look at the losses from the date that you purchased that security, which could have been several years ago. So that's also something to look at when analyzing these strategies. John, what about fixed income? So this year was really, really tricky for fixed income, and a lot of investors out there are holding fixed income securities, mostly getting that access through ETFs. A lot of those are down because of the rising rate environment. Does this strategy still work for fixed income securities?
Yeah, absolutely. Again, if you're in a loss position, you might want to look at triggering that loss to offset some of the gains. And you may want to get back into the market as well within that 30-day period. Obviously, you can't buy that same ETF, that same security, the bond, the preferred shares, or the fixed income ETF. But you could get back into a similar security. One point that I would make is that there is a position that CRA has that if you any ETF that tracks the same market, that even though it may be issued by a different issuer, if it's tracking the same market, that CRA considers that generally to be an identical security. So if you were to sell one issued by one company and then buy the same an ETF that tracks the same market by a different company, then the superficial loss rules would kick in and that strategy wouldn't work. The other point that I would make with fixed income is that in this rising interest rate environment, a lot of the bonds that have been issued with a lower coupon are probably going to be at a discount. They may offer the same yield to maturity as other bonds or other bond ETFs that have a higher rate of interest. But from a tax perspective, it could be more advantageous to buy the discounted bonds because the investment income mix between those two securities would be different. In the case where you've got the lower coupon rate selling at a discount, you'll be bringing in less interest income and a higher capital gain because the difference between what you pay to acquire that and the maturity value would be a capital gain. So from a tax perspective, it may be more advantageous simply because of the 50% income inclusion on capital gains. So there's an opportunity there within the fixed income world.
Yeah, we found discount bonds have been very, very popular, and direct investors are figuring it out pretty quickly how to manage tax in their portfolio, and discount bonds is certainly one of those strategies they're using. So if a discount bond is something that's not in your investment portfolio and you've been thinking about it and you're sitting on some fixed income losses, by the end of the year, you could consider looking at selling out of some of those aggregate bond exposures and looking into something like a discount bond to maintain your fixed income exposure, but again, layering in another level of a tax strategy for your portfolio. So some great points there, John. For investors out there that are thinking this might be a good fit for their account, their non-registered account this year, they'd like to take advantage of this strategy. What are some important considerations for those investors to be aware of?
Sure. Well, I guess the first one would be timing. It's important that any trades that you're undertaking to generate that capital loss will settle within the calendar year and could be used to offset gains realized earlier this year. So just the way the calendar works, the last trading date to be effective in 2023 will be December 27th. So just to take note of that, you can't leave it to the last minute. I'd also highlight some of the nuances around the superficial loss rules. So when you're selling a loss security and having to sit on the sidelines for 30 days before repurchasing that, I get a lot of questions. Well, can I repurchase it in my registered account? Can I repurchase it in my spouse's RSP? All these sorts of things. And Unfortunately, the rules are kind of one step ahead of us here, and you can't buy that same security that you've sold at a loss, and you can't repurchase that in any of your registered accounts, your TFSA, your RIF, your RSP, or similarly, any of those registered accounts of your spouse or common law partner. And similarly, you can't repurchase within a corporation that you or your spouse controls either. So some of those nuances there. Again, I highlighted that the investment mandate is very important. That should guide your decisions. So oftentimes we're looking at securities that you were thinking of selling probably in the near future or in the short term otherwise. And then, oftentimes it is a good idea to work with your tax advisor to make sure that this strategy works. We don't want any surprises at tax time. There's some nuances around calculating the cost base of certain securities with having to do a weighted average of that same security across all non-registered accounts that you may have. Return of capital can have an impact on cost base, any reorganizations, all that sort of thing. So it's important to be aware of what the cost base is for tax purposes so that you'll know that you've got a gain or loss when you sell it. As I mentioned, some of the superficial loss nuances, and just making sure that if you are carrying back a loss to the prior year, that you did pay tax on that and have a sense of what that refund might be, so that there's no surprises at tax time.
Great points. And you did say it earlier, but I will mention it again. If you are considering the strategy to use when trading in and out of ETFs, remember John said it, another thing to avoid for that superficial loss is staying within the same index. So if you're selling an ETF that's tracking the S&P 500, you can't go into another ETF that's tracking the S&P 500. The CRA has figured that one out on us. So watch out for that as well. John, this was very, very insightful. Our viewers love learning how to manage tax in their accounts, and your insight was very, very valuable. Thanks so much for taking the time to join us today.
It's my pleasure, Danielle.
And thanks to our audience for coming out today. We have a great show ready for you next week, as we always do. We have Investor Line coming on next week, and we are going to talk about managing currency in your portfolios. You don't want to miss that. We'll see you then.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.